Yes boys, how are we? In today's video I'm going to be teaching you how to spot a fair value gap, imbalance, FVG, whichever one you want to name it, in the market. So let's get straight into it and not waste any of your time. Let's go. So like last video, I'm going to do a little text drawing for you, as I feel like that helps a lot of people more. So let's get straight into that. Let's get this drawing up. So, what is a fair value gap? So on the last video, we did this, yeah, and we did this. So that's price, obviously going up, uptrend, price going down, downtrend. In the last video, we did broker structure. What's a broker structure? Price is here, price makes this low, price breaks this high. So that's a confluence that we're going up, 'cause it's breaking it. Here, price comes down, comes back up, breaks this high. It's a confluence we're going up. Alright, so that's the broker structure from the last video if you forgot. Now, what is a fair value gap? A fair value gap is a gap in the market where loads of orders are left, where price is going to revisit it, right? So here is a big gap in the market. So how it would work, we'll do it with this and then we'll hop into the actual market. So how it would work is price will tap back into this and then normally move up. You know what I'm saying? Right, so that's obviously with the bullish. You have the broker structure, you wait for the imbalance, it comes into the imbalance as you can see here, and then it always zooms up. It will make more sense when we go onto the charts. I'm just showing you this so it's easier. And it's the same way going down. So we had the broker structure, there was a high here, it's broken that high, you know what I'm saying, it's broken it. So that's for sells. It's done the same here, made a high here, broken it, broken it, broken it. So that's broker structure as you remember last time. Obviously, fair value gap is a big gap in the market. So here to here will be the gap. Price will come back up, revisit this gap, and move down. That's how it works. Now let's quickly jump straight in to the real market data instead of just drawing. Let's go. Right, so we're in the market right now. I'm going to give you a challenge. Go ahead from what I just said. Where is a gap in the market where I'm showing you right now? 5, 4, 3, 2, 1, boom. A fair value gap in the market would be from this wick to this wick, right? As you can see, there are loads. So, bankers are what actually move the market. So here, I've had loads of sell-off here, right? So there's loads of people in sells here. So price needs to come back up and retest this for it to move further down, right? So that's why the market moves. So this is a gap in the market where price needs to come and fill it. And when it does, it goes down. That's how it works. And if it doesn't, then it's an invalid fair value gap. So how it would work is you'd have your broker structure, which is here, the red line, the broker structure, which is what we did in the last video. And now we're doing the gap, the fair value gap. Here is the gap. You mark it out from the wick to the wick. Price revisits it, comes down, right? It's the gap in the market where the price needs to come back and revisit it and it will move down. So you had the broker structure back into this 5-minute fair value gap and it moves down, right? It might be a bit confusing, but let's just go and do it in a load of different opportunities. So that's how it works with the broker structure, and obviously in the next video it will be a liquidity sweep and all that stuff. It's all going to make sense. Just watch these one by one, and then on the end one where it's all together, it's all going to make sense. So that was scenario 1. Let's find another scenario where price comes back into a fair value gap. As you can see, here and here, this candle is a big impulsive candle as it has left a gap in the market. So we'll get the rectangle, mark it out wick to wick. As you can see, it comes in, enter there, stops below the fair value gap and target it higher. That's another one. Let's find another scenario. Another scenario, as you can see, a big impulse candle, gap in the market. You get it, wick to wick, price comes in and goes down. Let's keep finding them until you get it. Gap in the market, get your box, wick to wick, price comes in, goes down. It's the same stuff. But obviously you can't just go around using random gaps in the market and just going off them. That's why you have the broker structure, that's why you have the fair value gap. You put them together and you get the trade along with the liquidity sweep. So yeah, you can't just go around using random ones. 230 every open. You have all these three confluences together, which you will see soon, and you put them all together, and that's what makes a perfect trade. You don't just go around entering off random gaps. I'm just showing you. Do you know what I'm saying? The last one I'm going to show you now, just to get glued into your head. Here we see an impulsive move with a gap in the market. What are we doing? Wick to wick. What does price do? Comes into it, goes down. Another tip for you guys is most people, when they're using fair value gaps, when I use them, is you can use a 50% level. So obviously, as you can see in this fair value gap, you do this, and that's 50% of it, and you can enter when it hits 50%, and it gives you a better entry, so on. So that's another tip. So if we was going to use the broker structure and the fair value gap, which is everything we've learned so far, and we put it together, I'm going to show you what we get. So for example, we've had a broker structure to the downside, so price is going up, going up, going up, going up, going up. Boom, what did it do? Break structure to the downside. So that's giving us a confluence that is going down. Step 2, what are we waiting for? A gap in the market, which is here. An impulsive move here. So you get your rectangle, you do it from wick to wick. What have you got? Gap in the market. Price revisits it. Boom. Comes shooting down. As you can see, stops at the recent highs, this high, or you can even be brave, and there, boom, a 1 to 14 R right there, just with the broker structure, back into the fair value gap, enter, target your lower lows. So that's the broker structure with the fair value gap, and that's how you put it together in a trade and make money with it. Now the last step is liquidity sweep, which I'm going to be doing in the next video. So you've watched the broker structure one, you've watched this fair value gap one, and now the next one is going to be liquidity sweep, which is the main one which you need to watch, and you put it all together and you get this perfect strategy.